time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Awesome. Thank you. So yes, like you said, I am riding your coattails yet again. As you did cover this stock about 2 months ago, and following the release of its Q4 2022 results, the stock has declined about 11%, and we got a question that came in. So we thought that we would revisit the story to see the business's progress. So KBL Linen Inc., KBL on the TSX, currently trading at about $26.95 with a $290 million market cap and a dividend yield of about 4.4%. So KBL Linen is the largest owner and operator of laundry and linen processing facilities in Canada and a market leader for laundry and textile rental services in Scotland and the northeast of England. The company's operations in Canada include 9 processing facilities and 2 distribution centers in 10 Canadian cities, including Quebec City, Montreal, Toronto, Regina, Saskatoon, Prince Albert, Edmonton, Calgary, Vancouver, and Victoria. And the company's UK operations are across 6 locations. Now, for the most recent fiscal year, approximately 63% of its revenue came from its healthcare segment, while 37% came from the hospitality segment. And as you can see from the table that I have up on the screen here, if you're watching on YouTube, the business's hospitality segment took a massive hit in 2020 and 2021 because of the pandemic. But with the world reopening, the hospitality segment is finally getting back to its pre-pandemic highs. Now, just looking at some operational updates here, earlier this month, KBRO announced the closing of a share purchase agreement to acquire all the assets of a private laundry and linen services company operating in Quebec City for a total consideration of $11.5 million and a potential earnout of $1.9 million. And the purchase price will be satisfied by drawing down on the company's revolving credit facility. Now, there was no indication on the acquisition's financial results, though, so we do not know the multiple that was paid. Now, looking at the recent financial results for Q4 of 2022, which just came out, I believe, last week, revenue was $70.7 million, an increase of about 13.6%. And the growth here was driven primarily by a further recovery in its hospitality segment. EBITDA was $8.7 million, a decrease of about 2% from the same period last year. And EPS, or earnings per share, was about 2.5 cents. Which is a decline of 82% from 14 cents generated in Q4 of 2021. And the decline in EBITDA and net income was primarily due to the temporary labor inefficiencies from a tight labor market, higher natural gas rates, higher delivery costs related to increased diesel rates, and lower government assistance received. And margins were also impacted by the Alberta Health Services transition and the repricing of the corporation's existing business in Edmonton and Calgary with AHS, which took effect on August 1st of 2021 in advance of the business being fully transitioned. Now, looking at the balance sheet, the company has about $2.6 million in cash and debt and leases of about $98.8 million, providing a net debt position of about $96.2 million and a trailing net debt to EBITDA multiple of about 2.6 times. Now, keep in mind, this is pre the March acquisition, as these results are from December 31st of 2022. Now, looking at the valuation, the stock does trade with a trailing PE, or price to earnings multiple, of about 74 times and an enterprise value to EBITDA multiple of about 10.6 times. Now, looking at the management's outlooks, I will just provide a few comments here. So the reopening of economies will continue to support the strong recovery momentum in hospitality revenues. Management also said into 2023, management will continue to focus on optimizing plant efficiencies associated with the transition of new AHS business. And since March of 2022, KBL has faced significant volatility in energy costs due to current geopolitical issues. And in April 2022, to mitigate this instability, the company locked in natural gas supply rates in the UK until December of 2024. And based off of these locked-in rates on natural gas, as a percent of revenue, it's increased approximately 2.5% from historical levels for 2022. And as they move into 2023, they expect to mitigate these cost increases with price increases to customers. And we have seen these price increases just begin to start to come in at the end of Q4. Now, KBL also continues to face temporary labor inefficiencies from competitive labor markets, which management has no idea when this will ease. And management is confident in their ability to return to 2019 margin levels, which is anticipated to occur in the latter half of 2023. Now, looking at analyst estimates here, we did speak with management late last year. And at that time, we saw estimates from analysts, which seemed kind of out to lunch to us. And even, when we did speak with Linda, the CEO of KBRO, she told us that she believed a recovery was going to take a little bit longer than the analysts had actually indicated in their reports. So you can see here that the actual fiscal year results came in lower on EPS than what this one analyst firm as well as the other analyst firm had projected. And you can also see here that their fiscal 2023 guidance, they ended up revising quite a bit lower. The first analyst firm here from $1.98 to $1.30, and the second from $1.56 to just 85 cents. So we can see that big decrease there. Now, to conclude, I like KBRO Linen, and it's not just because it's operating in Saskatchewan. The company pays a nice dividend yield. They're profitable, but right now the business is just a little pricey for us, and we would like for the company to have a further pullback in its share price before we would potentially recommend the stock to our clients and just get those margins up, essentially, which we are monitoring at this time.
So where you have guidance there, those are the analyst forecasts, right?
Correct.
Right, yeah.
So like I've got like March 2022, that's when they actually came out with this guidance. So March 2022, and then in March of 2023, they revised it lower. So just recently here. So yes, hopefully that makes sense.
Yeah, the estimates there. Yeah, the estimates. I mean, and they were, to be honest, out to lunch on
Yeah,
that.
and even Linda
and
said
you're
to
looking
us.
a year out,
Yeah.
$1.98. We're not going to mention who these
No.
came from, but some of the big banks and a
Yep.
boutique. This is a big bank and a boutique firm that came out and said, a year out, 2023. $1.98 in adjusted EPS, then just ratcheting that down to $1.30, but then the $1.56 down to 85. I mean, if you're off by that magnitude, and management is saying, in an interview to us that those estimates that we're looking at look off, then either you should be talking to management a little more, or you just don't know what you're doing, or shouldn't be estimating that far out, to be honest. And it's actually, it's kind of shocking how many times we'll talk to a management team and either find out that's a brokerage firm that has an estimate on them, hasn't spoken with them, the analyst hasn't spoken with them, or they just completely disagree with the numbers. And either the work is not being put in, or they're just inflating the numbers because they know the company needs financing, and that looks better, to have a higher number. I'm not sure, but it doesn't seem to be in the interest of an individual investor to go off those estimates. If you've been going off those estimates on KBRO over the past year, you'd be losing money because they're not hitting on those estimates. And that's what, when we look at KBRO, they do need to increase their margins. They just haven't been hitting on those revenues. I think in their last 10 years are up 2 times, which is great, but SG&A is up 3.2 times, and the profitability just isn't there right now. It may come back. Management is saying the margin level should come back, but we'll give it a couple more quarters to see that progress actually happening. And I think you'll have time to be able to buy in if we really do see some value there. But they need to actually hit on their targets before we would buy back into the stock again.
Yep.